Welcome to Truth, Money, and Freedom. Today is Monday, March 25th, 2019. And here's a new story from Zero Hedge. Of course, the yield curve crashes. 10-year yield plunges below Fed funds with 3-month and 10-year in free fall. That's the right here, I believe, is the what the quote unquote data dependent Fed looks at for a recession. It's actually that they hit the marker that says we're probably going into a recession. So they may talk about it a little bit more now, be a little more honest about it. At least that's what it looks like, because that's what always happens. I'm not going to read this whole article to you, but I will read a couple of sentences here. Meanwhile, the Fed's favorite recession indicator, the spread between the 3-month bill and the 10-year Treasury, has plunged further into negative territory. At last check, had dropped as low as negative 7 basis points, as the next U.S. recession is now barreling towards the United States. So here's what they're talking about with that curve. I'm going to bring it a little closer for you so you can see it better. You see they're calling it the Nike curve, or the Nike swoosh curve. You see here is the 1 month, the 1 month Treasury, the 2 month Treasury, 3-month Treasury, 6-month Treasury, and then the 1-year Treasury. Now, they're all above 2.4% on their yields. If you go across this line here, you can hit the 10-year. So literally, these short-term treasuries are all paying more on their yields than the 10-year is. And then of course everything else is paying less. So that's that's an inversion, gang. That's what a yield curve inversion looks like. These are the signs we look at for recession. There are other indicators too, and I know I don't talk about them enough, but this isn't the only thing. The talking heads on the mainstream media will be saying this isn't a big deal. This doesn't mean for sure there's a recession. In my mind, it does, because not only do we have this, but we also have the auto crisis going on right now with auto loans. Not only are the auto manufacturers hurting because sales are down, but there's an enormous amount of defaults. 7 million car loans are currently in default. If that's not bad enough, you have to look at the retail apocalypse, which no one likes to talk about, because this has been going on. This retail apocalypse has been going on since 2008. We never healed, folks, because they didn't fix the problems from 2008. They papered them over by printing money and lowering interest rates. That's all they did. What they did is they held it off a little bit longer. And I don't think the Fed can actually deal with it this next time around, because they didn't normalize interest rates. There's a 180-degree turn, an about face from their policy to normalize the economy. We're still in emergency mode, folks, and they couldn't bring us to 5%. So what does this mean exactly? Well, if they couldn't get us back to normalized interest rates, and they've paused hiking rates, they say they'll hike again one more time in 2020. They won't. I doubt it. They know that they'll kill the housing market, they'll kill the stock market. So, I mean, that's it. So basically, we get to see interest rates come back down again now. So those of you who are wanting to refinance your home, you may have a real good, chance to get it at a very good rate again sometime in the next 2 years or so. We'll see how far down they take it, how quickly it happens. When is this going to happen? I don't know. Like I said, I can be a guy who predicts and gives you a date, but I will be wrong just like everyone else. No one knows exactly when these things actually take shape, take form. In the regular economy anyway. I mean, clearly things are really heating up in the bond market. But I'm not a financial consultant either, and I never claimed to be. But smart money is moving around, guys, and it's moving from the bond market to and from the bond market, and I suspect the next step is into precious metals. That's the only thing that makes sense at this point, possibly into cryptocurrencies as well. So it might be a good idea to hedge your bets and get some precious metals, some gold, some silver, and maybe get a little bit of Bitcoin. It certainly can't hurt. That's what I've done, and I Like I said, I'm not a financial consultant, but people do ask me all the time, what do you do when this next one hits? This next one's going to be the big one, folks. There's be some very serious economic activity happening in this next one here because we literally couldn't even get back to normal. So all the means they used to actually get us up and running again after 2008, they don't have those means anymore. Now they can always print more money, and even Alan Greenspan said they can print to infinity, but what they can't guarantee is a purchasing power. So what that means is if they decide to go ahead and print a lot more money, they'll just literally increase inflation, take us into big inflation and ultimately into hyperinflation. That's what's happening in Venezuela, it's happened in Zimbabwe, and these are modern day examples. We don't have to go back to Weimar Germany to get examples of hyperinflation and how bad it is. Venezuela's hurting really bad, and in fact, it looks like Russia's invading Venezuela right now. That'll be another story. Ellie, 1978, by the way, is covering that pretty well on her channel, and I think she's doing a good job there. So I don't think it would be a good use of my time to bring that stuff up. But if you all are interested, leave in the comment section if you want more updates on Venezuela and Russia, because that's getting to be a very interesting story now too. Didn't mean to take up so much of your time, but I did want you guys to see this. And if you don't mind, I'm going to continue reporting as this yield curve inverts, because it kind of gives us a little bit of a timestamp. I don't know exactly how far we are into this curve as opposed to the 2008 curve for when things really start to happen, but we're not quite there yet. But this is the warning sign. You know how if you've ever been to the ocean and that the tide is coming in because the water moves out. The water moves out into the ocean before it comes back in. Well, this is what we're seeing right now as the water's receding. So that's the way I like to equate it. For those of you who aren't really familiar with the curve, the yield curve for the bond market, and how, basically it ultimately affects, the economy when you have an inverse curve. The inverse curve, when it's inverting and it's getting deeper and deeper like this, what this is that's the water receding when you're at the ocean right before the tide hits. And the deeper the inversion is, the bigger the tide will be in when it comes in. And what I'm talking about is a snapback in the actual curve rate. Suddenly these bonds will sell off. The reason these are going so low is because they're getting purchased. That's, it doesn't make a whole lot of sense, I know, but when bonds are getting purchased, the yield curve or the yields go down. When bonds are selling off, the yields will start going up to make them more attractive, to purchase. So that's the way the bond market works. But at any rate, when the tide comes in is when the yield curve snaps back up again. And that's, something that will happen at some point. We just don't know when. But that would be the money leaving the bond market because they're too scared to even be in the bond market because things are looking really bad. That's generally when people fly into precious metals. And getting there first is a good idea because there's no such thing as being late on precious metals because they just run out. There's just not enough of them to service everybody. I am not a financial consultant, though, so just keep that in mind. But that's what I've done for me and my family. That's something you may want to consider as well because I can't think of any other assets that are really good besides crypto and precious metals. At any rate, I will keep you updated if there are any more changes in the yield curve, if it deepens. And these are sharp movements we're seeing here, and that's why I keep bringing it up. I don't want to kick the dead horse, but I don't recall them being this sharp in 2007, going into 2008. So it was a slower curve. This curve is happening pretty fast, so that's why I keep bringing it up. Any rate, I hope you all have a wonderful day. And remember now, we're Truth, Money, and Freedom. If you check in the description section below, you'll see a link to us. You can actually come in and visit with us. We have a chat group that actually has a voice chat as well as a text chat. And also, I'd like to say at the end of this, this is the libertarian in me. This is my little speech I'm going to try to do at the end of every podcast. Income tax, so you know that you don't own your labor. Sales tax, in case you thought you owned that money. Inflation, just in case you're foolish enough to save. Capital gains tax, to punish you for trying to get ahead of inflation. Property tax, so you know you can't own anything. Inheritance tax, so you can't pass on what little is left. All right, gang, you guys have a wonderful evening.